Today what we're going to talk about here is in this small talk, first of all, we're not going to do any maths, okay? It's been super interesting and really quite deep at times and very, very cool, I find. But this is really just giving you an idea of certain use cases in the financial services industry where zero-knowledge proofs could be used, okay? It's not, as you can see probably in my outfit, but also on the slide, it's not a corporate talk we're going to do here. And by saying that, I put also this disclaimer. So whatever I'm going to say here, it's my personal opinion. It's not related to the institution I work for or any of my fellow colleagues. Having said that, so I would nevertheless say something about, a few words about the EIB. So the European Investment Bank is headquartered here in Luxembourg. We are all over Europe, but also a little outside worldwide. And so since this is a startup event and new technologies, fintech event, I would say, the EIB and the EIF, which is part of the EIB group, there's a lot of funding in this space through Horizon 2020, for example. Okay, and so in addition to that, the EIB is also quite aware of new technologies. We're following it quite closely. And for example, last year we organized a hackathon, which was basically putting a financial instrument, which is a commercial paper on the blockchain and see actually how that would look like. And we saw really the various different types from complete disintermediation until partially, non-partially phased approach and all of that, which was very interesting. And we took that a further step, which was basically doing it in a proof of value or an additional proof of concept with some form of integration and learning some lines. Now, that was an announcement by Euroclear recently done, and that's basically at this stage all I can say because there are some parts which are under NDA. Good, and then we are talking about NDA, which we'll pick up later. All right, so let's dive into this. Our agenda here is we're going to have it in a couple of use cases for financial services. I like to actually distinguish or say traditional finance, probably saw it on one of the slides as well, it says for traditional finance as opposed to, let's say, decentralized finance or open finance, whatever you want to call it. And then we're going to have a look at are zero-knowledge proofs really needed? What are the alternatives? And then some production examples, a couple of conclusions, my private contact there, and there are two more slides depending on how we go. We can have a look at that. So the first use case, it's pretty obvious, which is basically in KYC, know your customer, and the enrollment, the onboarding basically. And what you can do with a zero-knowledge proof is basically you can check, do you live in the EU? Do you live in Asia? Do you live in the United States? Or do you live wherever actually without revealing the country itself? Okay, but also, do you have an EU passport? So that's a little bit more tricky because they're not all standardized and so forth. But you could think of, okay, you take a snapshot, you take a hash function of that, and you actually use that as proof, and that is verifiable. But also, are you above 18? You don't want to give out necessarily everywhere on all websites your date of birth, as you know, quite often. That is just used then for authentication, which is a very bad authentication, of course. But you don't want to reveal that and put that on any random site, which will be hacked tomorrow. So, and yeah, so you can use it for that use case. So that's our first one. And there are others that you could think of. Here are just some examples of what you could, those type of questions that you could ask. Second use case we can think of is basically personal finance. So loans, but not only personal finance, also for businesses. Mortgages, finance, credit cards, and also credit scoring and these type of things. So think of, do you have pension rights? Maybe you need to prove that in order to show actually what is your financial worth and what is your financial assets without revealing them, without actually revealing also the authority. Where did you gain them? Let's say you have lived in 4 or 5 different countries. You do not necessarily want to reveal that, but you have to prove that you have some certain credit worthiness in order to get a mortgage, to get a loan and so forth. And this is a valid use case. Or boundaries, let's say income bounds between X and Y euros or US dollars or whichever currency it is. That type of information, financial information, you usually don't want to give away, right? Do you have other incomes? Well, yes, but if you don't want to give them away. So you could do that. Then our next use case, this is actually a little bit more, there are some areas in a traditional financial institution, let's say in a bank, for example, that may be used, that can be used for investment strategy, but also financial risk and regulatory window. So in terms of portfolio allocation, you might want to ask, does it match actually investors, regulators, or potential stakeholders' profile in terms of risk profile, in terms of investment strategy, and in terms of regulatory requirements? We'll break that down now in the next couple of slides. So, who's familiar with concentration limits? Concentration limits, okay. Concentration limits just means basically you have concentration in a certain in a certain location, for example, or certain assets which just come together, and you do not want that in order actually to have a certain diversification, okay. And that risk management is quite concerned with it. Can also be the asset class, the asset type, and so forth. We'll see some more slides on that. But yeah, do you only invest within the EU? That might be a valid question that either your investor, depending on the investment strategy, has, or your regulator, that might be a question, or also per sector. So do you invest in RegTech, FinTech, InsurTech, BlueTech, whatever, which may be our strategy without revealing it, and you could prove that, okay, without giving the exact details. Again, about portfolio allocation is basically, do you match our liquidity, asset quality, and asset class requirements? So per asset quality, let's say, do you only have HQLA that you invest in, high quality liquid assets, or they only use treasury bonds, so safe assets, so to speak, or let's say government bonds or anything like that? So that you could check. Your maturity, without giving the maturity, so is it short term, is it long term that you only invest in? And the type of asset class, so only debt based, only equity based, only crypto, or only real estate, or is it only in funds that your fund invests in, and so forth. And yeah, last but not least on this slide, actually the asset type. So is it again corporate debt, equity, or all these types of different distinctions that we can make, or public sector debt versus private sector debt. You can think of many other forms here that you want to actually drill down and actually get those questions and answers to, but these are valid use cases. It all falls into this portfolio allocation, basically. And we'll have 2 more slides on that. Basically, this is more about really the ranges and the structure. So before we were just looking at the static data on certain assets, but now what is actually our range? So does it fall between 20%, 30%, whatever percentage of a given currency, right? Or do we only have issuers in EU, or only have issuers from Asia, or from wherever in the world, or from Australia, or so forth? And you want to split that in certain ranges, so in bounds of certain percentages. About fund size, you can also say the same. So let's say your fund is between 50 and 100 million euros, so it's a relatively small fund. If it's below 50 million, you could potentially say, well, it's probably not profitable because they'll have too many expenses and so forth. Maybe we don't want to invest in that. The funds, quite a few funds, they do not like to reveal precisely their assets under management. Or if you say between 100 and 200, those type of funds, they tend to be more profitable. That could be a strategy. And in terms of asset rating, so what does Fitch, Moody, and so forth, what do they say? You can have also a certain criteria for that. Okay, and it's all about diversification. Now this is about, so sanctions can be with regard to without revealing again, the portfolio or actually the transactions. Okay, and that can be risk. So it can be financial risk, but it can also be liability risk. There can be various types of risks that are behind their reputational risk. If you invested in that fund, they had done a dodgy transaction, you don't want that. But also, of course, that fund would not want to reveal those transactions to you before, or actually the portfolios under management. So per risk profile, low risk transactions and high risk transactions, you can have various parameters on that. Now, what are the alternatives, really? There are not so many, I would say, and they're not really scalable. So if you, in terms of zero-knowledge proofs alternatives, what it basically boils down to is legal agreements, non-disclosure agreements, actually, or just giving up your data. So usually that's quite expensive. Think of legal fees. They're usually quite expensive. If you have to do it one-on-one, that's quite expensive in terms of manpower, or actually you lose your private data. So if you lose your private data, you give that up, you give that to, let's say, that big company that hoards all your data, masses all your data, then that is a cost that you're actually paying, which you're probably not directly aware of, but that is something that is a cost ultimately.
Audits, no?
Sorry?
Audits also.
Yeah, audits also, yeah. And a lot of this is not really so scalable, and because most of it's not really legal structures. They're mostly, if they're digitally, they're just partially digital. That's also why it's expensive, and you cannot scale up that easy. Okay. So some production examples of zero-knowledge proofs. Yeah, of course, privacy coins. I think you had yesterday a ZKLux, and so any of those Z whatever coins that are out there. So even be it privacy coins, strictly speaking. So Zcash was probably the first one which came out, or utility coins which have actually privacy features built in. Then permission chains. They have quite a bit of zero-knowledge proof stuff. Then also, for example, this one, Corda, they try to solve actually scalability problem through zero-knowledge proofs. I think they actually basically use the history, the blockchain history, and actually compress that and try to solve the scalability problem with that. There's also Project Franklin, Matter Labs. I think they were supposed to be here, or no?
They're supposed to be here. They will be here via Skype later on.
Ah, okay, cool. Yeah, and Project Isekai, so these are frameworks. In the, let's say, traditional financial world, ING is probably one of the, from the existing banks, we're pretty advanced in this area with ING bullet ranges. This is these range type of things that I showed you earlier. This is really already existing. And yeah, Ernst & Young Nightfall, for example. There's also something on Bitcoin which will be revealed, which we'll probably put in the core protocol, and many other projects. Okay. Now, some conclusions. What we can say at this stage is that, yeah, there are use cases and some examples already in the traditional financial services. Probably more should be analyzed and looked at and built. But what we can also say is that in the, let's say, blockchain ecosystem and the traditional, decentralized or open finance, there's, let's say, they seem to be a step ahead. They're more in production use cases ready at this moment. And then, yeah, transparency versus privacy on public chains. That's one of the hindering factors why, in terms of larger adoption. There are other reasons, but this is one. I would say one reason. So we still have a little time, yeah? So I just have this contact. If you want to contact me, I have some strange emails sometimes, but yeah, so a little when it gets open, I keep some open emails. So 2 more slides. Privacy rendering cryptography. That is out of space view or helicopter view, really. I think Claude could explain that much better than I could, but let's just do a quick rundown to summarize. So symmetric cryptography is basically your encryption and your decryption key are the same or very similar. And asymmetric cryptography, you have different keys. Usually you have 2 key sets for key management purposes, but one does the sign and verify, and one does the encrypt and decrypt. Proxy re-encryption, not so many people talk about it, but there are also some projects in the space already. NuCypher, for example. It's asymmetric cryptography. You have a proxy in the middle, and basically the proxy, so trusted third-party element, actually reverses it. And what you can do and what you get as an advantage out of this is that you can get this right to forget, and you can revoke basically the access rights. That's quite powerful, and potentially that could solve some of the GDPR requirements of the right to forget. Zero knowledge proof. The whole 2 days are about this today, so I'm not going to go into much detail more here. Homomorphic encryption was also mentioned a few times in the last 2 days. So that's basically a mix of symmetric and asymmetric cryptography. You encrypt data, and basically you run computation on that data. And the result is the same as if you were running the same algorithm actually on the plain text. It's very powerful, but currently quite expensive still. But potentially that could replace, but perhaps zero knowledge proofs in the future. Who knows? And then trusted computing we could also discuss. But this is like trusted enclaves where some hardware manufacturers actually build secure hardware. The question boils down to trust. Do you trust that manufacturer? Do you trust that chipset, and so forth? So that's a small rundown on this side. And last, the last slide is here basically. Privacy seems to a little bit be less hard to solve on permission blockchains. I would say primarily, probably not the only reason, but on the trust model, so everybody's identified. Zero knowledge proofs tend to be more expensive on public chains. For example, gas consumption, as we saw with Nightfall, Ernst & Young Nightfall, they tried to improve that, but it's still relatively expensive. And then, okay, that's my personal opinion. As I said, everything that I said here is just my personal opinion, nothing related with the organization I work for. I believe that public blockchain is really, in the mid-long run, the way to go for those 4 reasons. It's high security, network effects, higher network effects, larger network effects, and they're real commons. So it doesn't have the tragedy of commons problem if the crypto economics is correct. That's, of course, the tricky part. And yes, we're having a discussion earlier on about blockchains, are they expensive or not? Blockchains, in generally, they tend to be expensive because they're distributed systems. However, it's a question of, and since you mutualize the cost with other participants, they can be cheaper. So, and that the larger the network is, then you actually mutualize that cost at a better way. And that's why I think the 4 reasons the public blockchains in the long run at least will outrun. And there are 2 reasons why permission blockchains are very strong. So let's say on the moment for corporate, one is actually the legal liability. So usually in blockchains you have mutual and common liability between the parties that organizations like and would like to minimize to a certain extent. And the second part is all this is about the privacy aspect. So that's easier to do on permissioned blockchains right now. Thank you, guys. Thank you.
Hi, I was wondering if you had any use cases for the healthcare system, maybe patient.
That's a very good point. So we were just looking today here at financial use cases, but of course there are also other use cases. There's digital identity. It's a key one, a very big one. We could mention there, for example, I'll come to the word later on. But yeah, so healthcare data, and there are some projects which are working on that. They're more or less waiting actually on the homomorphic encryption being becoming cheaper. But then so.
Actually, in the US, so there's the healthcare application is much more popular in the context of zero knowledge proofs. Like 2 out of 3 papers in zero knowledge proofs they mentioned a sort of healthcare application.
Because healthcare is such a big business,
You
have to pay for it.
So I have a question. So about the use cases you mentioned about, for example, some portfolio content proof. But are the data or your portfolios already in the necessary digital form, like the content, and for example, so some third party can certify that my portfolio has like 10% of oil and.
Yeah. No, it depends on, let's say, which area of the traditional financial system you look at. So if you are more on the private equity side, a lot of stuff is still in Excel and so forth, but they also have tools. But if you go more and more, let's say, on the IPO side, so on public equity side, then actually everything is digitalized and all the trading and stuff is digitalized. All of that is already digitalized. If you look at in a traditional financial institution in the treasury, you usually have a treasury system, and you have very good solid reports, and you have a database or several database, whatever, actually where you can all get that data from. Yeah. And then, okay, there's also, again, it boils down a little bit to the level of trust. That's a general concept. Whoever you do business with, of course, there needs to be a trust. If you think that organization, which is supposed you want to do business with, probably you shouldn't then do business in the first place with. If you think they could then later on tamper it also. Verifiable claims, that's what I wanted to say. So verifiable in terms of digital identity. Digital identity, there's a W3C standard which came out 1 or 2 years ago, which has that at use case, and I think they use some zero knowledge stuff as well.
Would there be like a downside to me proving something to someone and then them using that knowledge to kind of collect data on me and use it in other places?
That goes more into the self-sovereign digital identity direction, so that you do not have sovereign entities, let's say the country, let's say just the given country, which actually verifies with my passport, or you are Mr. So-and-so, but that actually you have within a network of trust, a web of trust, so to speak, you have certain people. You could also build this reputation base that you gain certain reputation. For example, Guillaume is actually someone who verifies this, and then if he does many mistakes, actually his reputation could go down, right? But within each other, we could actually identify ourselves. So yeah. Okay, great. Thank you. Thanks a lot.